Happy to meet you all. Today we are going to learn the concept of Accounting Standard 2 Valuation of Inventories. So what is meant by inventories? The business may have inventory either in the form of raw material, work in progress and finished goods or stock in trade. If the business is involved in the production process means it will have raw material, work in progress and finished goods. If the business is in the trading nature means it will have stock in trade only. So what is meant by raw material? It is a kind of inventory held in business for further production process or rendering of services. Work in progress refers to those which are in between the production process. Finished goods or stock in trade are those which are held in the business for sale. AS is not applicable in the following areas. First one, work in progress under construction contracts because it is separately dealt in AS 7, work in progress of the service providers. And the next one is shares, debentures or any other financial instruments held in the business as stock in trade. Final one is producers inventories of livestock, agricultural and forestry products, mineral oils, ores and gases. The preamble of AS2 is inventories are valued at cost or net realizable value, whichever is lower. The rule is framed based upon the concept of prudence. Normally, goods are valued at cost because if the goods do not have any damages or obsolescence, the selling price of the goods will be obviously higher than the cost. So, in normal occasions, the goods cost will be always lower and its selling price will always be higher. Let's see what will happen if there is no rule of AS2. We will get it clear through example. In the given situation, the business is having closing stock with the cost of 75,000 rupees and its market price is rupees 1 lakh. If the goods are valued at cost, the gross profit is 25,000 and if it is valued at market price, it will be 50,000. Even though there is no change in the situation, there is a possibility of two profits. One is a normal profit and another one is a increased profit. Thus, as per the concept of prudence, the profit should not be overstated. Thus, it leads to the frame the rule as whichever is lower. If not, the enterprise will be eager to show the overstated profit. Next, the rule has two parts. One is cost and another one is net realizable value. First, we will look after the cost. Cost includes three parts. First one is cost of purchase. Next one is conversion cost. Third one is other cost to bring the inventory to the present location and condition. The conversion cost includes labor and production overheads. The production overhead will be further classified into variable production overhead and fixed production overhead. The labor overheads and variable production overheads shall be charged based upon the actual usage, that is how many labor has worked and how many machine has worked, what is the amount paid to them, etc. But it is not the same in case of fixed overheads because the fixed overheads will be charged in the normal capacity basis but not based upon the actual basis like overheads. You may think why there is a different treatment in respect of fixed cost alone. First, think about what is fixed cost. As we learned in basic economics in CPT or foundation, fixed cost is the cost which will not change, it remains fixed, etc. But that is right only for the certain extent. So what's meant by fixed cost? Fixed cost is the one which will incur even if the business is not in operation. That is, it is unavoidable. Fixed cost will change not based upon per unit basis but based upon capacity. Let's take an example of CA coaching center. Let's assume that the coaching center is having only two expenses. One is study materials for students and another one is rent. The study material should be distributed to the students is a variable expense because the amount spent on study material shall be done for each and every student, because I need to spend for study materials only for the students who are enrolled for the coaching. That is, if there are 55 students means I will spend for 55 study materials. If there are 95 students means I will spend for 95 study materials. Thus, variable expense will change per unit basis, that is for each and every student. Now we will look into rent. I have taken rented premises for 25,000 per month with a seating capacity of 100 students to occupy the hall. Even if the coaching center been running or not, I needs to pay the rent. Thus, it is unavoidable. Then, whatever may be the student strength, I need to pay a rent of rupees 25,000. Even if the student strength is 55 or 95, I need to pay the monthly rent of rupees 25,000 rupees irrespective of the number of students. Still the strength is 100. So thus fixed cost will not change till the strength is 100. What will happen if the strength goes beyond the capacity? I will try to accommodate the additional students in the same coaching center, like putting extra chairs and benches. But anyhow, if the strength goes beyond 110, it is not possible to hold the same center for total students. Thus, fixed cost will change once the total capacity being changed. Fixed cost per unit formula is actual fixed cost divided by normal capacity. Fixed overhead is charged on the inventories by multiplying the fixed cost per unit into actual output quantity. But there may be a chance that the output is either higher than the normal capacity or lower than the normal capacity. Let's understand with the example of illustration. Normal capacity is 50,000 units and the actual fixed overhead is 5 lakhs rupees. So the recovery rate, that is fixed cost per unit, is actual fixed overhead divided by normal capacity of units, which comes to 5 lakhs divided by 50,000, which is rupees 10. If the actual output is lower than the normal capacity, then it is termed as under absorption, because the business fixed cost cannot be fully recovered in this situation. The fixed overhead that can be absorbed is only 4,20,000 rupees, which is nothing but actual quantity into fixed cost per unit, 4,20,000 rupees. The balance 80,000 is considered as a period cost and will not be considered for cost of inventories. Next situation, if the actual output is higher than the normal capacity, then it is termed as a over absorption, because the business worked effectively and produced more units than the normal capacity. But however, the fixed cost cannot be higher than the actual fixed cost by applying the above mentioned formula. That is, if the above formula is applied, actual output quantity into fixed cost per unit, the amount comes to 6 lakhs rupees, but the actual fixed cost is only rupees 5 lakhs. So it should not be more than 5 lakhs. Third and last part of the cost is other cost to bring the inventory to present location and condition. That includes specific designing cost and any other cost to bring the inventory to the present location and condition, but it does not include interest and other borrowing cost and also any other expenses that is happening after reaching the location and condition. Next one is special case to identify the cost for joint products and byproducts. In case of joint products, compute the total cost for all products and apportion the cost on rational and consistent basis through relative sale value at split off point, physical quantities method, etc. And for the byproducts, the method is similarly as same as joint products. Thus compute total joint cost for all the products. Compute the net realizable value of byproduct or scrap. Net joint cost is step 1 minus step 2. Apportion the above calculated cost in a rational and consistent basis through relative sale value at split off point, physical quantities method, etc. Next we will get into the practical problems relating to the aspect of cost. Please click the link mentioned in the description of this video to download the practical questions. Star Private Limited, a wholesaler in food and other agro products, has valued the year-end inventory on net realizable value on the ground that AS2 does not apply to the inventory of agriculture products. Comment. The above question deals with applicability of AS2. The question is like a case study. So, this kind of question should contain three aspects. The first one is principle, followed with analysis, and then conclusion. So, in principle, as per AS2, it does not apply to the producers of inventories of livestock, agricultural and forest products, mineral oils, ores and gases. In the given case, the enterprise is not a manufacturer but a trader, that is wholesaler. So it is contradictory with AS2 if they value the goods at net realizable value basis. So as an auditor, we need to advise the management of the company to value the inventories as per AS2. If not, we need to qualify the audit report. In conclusion, I explained the qualification of audit report. So here we need to know what are the different kinds of opinion that can be expressed by the auditor in his audit report. The auditor can express four kinds of opinion. First one is qualified, and the next one is unqualified opinion, and the next one is disclaimer opinion, and the final is adverse opinion. So qualified opinion means it is expressed when the financial statement is not in accordance with generally accepted accounting principles, but there is no misrepresentation in the financial statements. Then unqualified opinion is expressed when the financial statement shows the financial results and the financial position of the enterprise clearly and fairly. The disclaimer opinion is expressed when the auditor is not in position to express the opinion on the financial statement. It may be due to non-availability of sufficient records or information. Adverse opinion is expressed by the auditor when the financial statement is not in accordance with generally accepted accounting principles. And also there is a gross misrepresentation in the financial statement. That means the financial statement is expressing the wrong figures and information. Next, we will move on to the next question. Captain Rogers Limited ordered 16,000 kg of certain material at rupees 160 rupees per kg. The purchase price includes GST of rupees 10 per kg, in respect of which input credit is available. Freight incurred amounted to rupees 1,40,160 rupees. Normal transit loss is 2%. The company actually received 15,500 kgs and consumed 13,600 kg of material. Compute the cost of inventory under AS2 and the amount of abnormal loss. So first we need to find the quantities information pertaining to the above question at different stages. So, the total quantity ordered by the concern is 16,000 kgs. The quantity which should have been received after normal loss at 2%. So, the normal loss at 2% is 16,000 into 2%, that comes to 320 kgs. So, balance should have been received after normal loss should be 15,680 kgs, which is the balancing figure. From the 15,600 kgs, the concern had actually received only 15,500 kgs. The balance kgs of the goods had not been received, which is nothing but abnormal loss 180 kgs. That is the balancing figure in this stage. And the next one is from the 15,500 kgs which is actually received, the enterprise had consumed 13,600 kgs and the balance is lying in the closing stock as 1900 kgs as a balancing figure. Before getting into the problem, first we need to know what's mean by normal loss and abnormal loss. Normal loss is the loss which is inevitable and unavoidable. It will surely happen for the particular nature of business. But abnormal loss is the loss happened above the limit of normal loss. The best example to explain the normal loss is transportation of petroleum products. When the petrol is loaded in the tanker and delivered to the retail outlet, that is petrol bunk, the quantity loaded in the tanker will not be the same when it is delivered to the retail outlet. We all know that this is due to the evaporation. So, the cost should be calculated for the quantity arrived after considering normal loss. Let's get into the problem. The purchase cost does not include GST because input tax credit is available in this case. So, the cost without GST should be considered for valuation. Thus, the amount is calculated by 16,000 kgs into 160 rupees and minus 10 rupees of input tax credit, which is nothing but 150. So, 16,000 into 150, which comes to 24 lakhs. Then we need to add freight because it is considered to bring the inventory to the present location. So it should be considered for the valuation, that is 1,40,000 and 160. So the total cost of inventory is 25,40,160 rupees. Thus the total comes to 25,40,160. Effective cost per kg is calculated by total cost divided by quantity should have been received after considering the normal loss. So the effective cost per kg is 162, which is nothing but 25,40,160 divided by 15,680 kgs. That is cost per kg is 162 rupees. So the valuation of inventory and abnormal loss is as follows. The cost of material consumed 13,600 into 162, which comes to 22,03,200, and the cost of abnormal loss is 180 into 162, which comes to 29,160, and the cost of closing stock is 1,900 into 162, which comes to 3,07,800. Next, we are going to see the methods of valuation of inventories. The method for valuation of inventory will be chosen based upon the category of goods. If it is a normal goods, that is goods which are same nature, same variety, which can be interchangeable or mentioned as a normal goods. There are two methods are available for valuation of normal goods as per AS2. First one is first in first out method and the next one is weighted average cost method. FIFO refers to the goods which are arrived first will be sold first and the goods available in the stock is the latest goods. So the value will be calculated based upon the latest lots received. Next, weighted average cost method. It is calculated by the formula total cost of goods received divided by total quantity of goods purchased. This gives the average price for the different purchase lots. Next, we will move on to the methods of valuation of goods for the special goods which are not interchangeable. In respect of these goods, we need to identify each and every items individually with a specific identification cost method. Next, we will get into the practical problems relating to this aspect. So, the third question is as follows. BP is leading distributor of petrol. A detailed inventory of petrol in hand is taken when the books are closed at the end of each month. At the end of the month, the following information is available. Sales 47 lakhs 25,000 rupees. General overhead cost 1 lakh 25,000 rupees. In the inventory at the beginning, 1 lakh liters at 15 rupees per liter. Purchases in the following month. A. On June 1, 2 lakh liters at rupees 14 rupees 25 paise. On June 30, 1 lakh liters at rupees 15 rupees 15 paise. And the closing inventory is 1 lakh 30,000 liters. Compute the following by the FIFO as per AS2. Question number 1. Value of inventory on June 30. Question number 2. Amount of cost of goods sold for June. Question number 3. Profit or loss for the month of June. In this problem, first we need to calculate the value of closing stock as per FIFO method. As per FIFO method, the goods which first come will get first sold and the last come will be stayed as a closing stock. So, the closing inventory which is given in the problem 1,30,000 liters. That 1,30,000 liters is from the latest lots as per FIFO method. There are only two lots in the problem. One is in the end of the month and another one is from the beginning of the month. So, the latest lot is 1 lakh liters and the balance in the closing inventory is from the previous lot which is in the beginning of the month. So, the balance 30,000 liters is from the beginning of the month. End of the month lot is 1 lakh liters into 15 rupees 15 paise which comes to 15 lakhs 15,000 rupees and the balance is 30,000 liters into 14 rupees 25 paise, that's equal to 4 lakh 27,500 rupees. So totally 19 lakhs 42,500 is the value of closing inventory as per FIFO method. Next we will move on to the computation of cost of goods sold. So the cost of goods sold formula is opening stock plus purchases minus closing stock. So the opening stock is 1 lakh liters into 15 rupees which is 15 lakhs rupees. Purchases is 2 lakhs liters into 14 rupees 25 paise plus 1 lakh liters into 15 rupees 15 paise. The total is 43 lakhs 65,000 rupees and the cost of closing stock is 19 lakhs 42,500. Hence the cost of goods sold is 39 lakhs 22,500 rupees. Next, profit for the month of June is as follows. The sales is 47 lakh 25,000 rupees and the cost of goods sold is 39 lakh 22,500 and the general overhead mentioned in the problem is 1 lakh 25,000 rupees. The profit is for the June 6 lakh 77,500. Next we will move on to net realizable value. It is calculated as follows. Expected selling price minus estimated completion cost of the product. This applies if the product is semi-finished goods and not a finished goods. Then reducing the estimated cost to sell the product. After all these, we will get the net realizable value. The inventory should be valued at cost or net realizable value, whichever is lower. But normally, the cost is always lower when compared with the net realizable value. But sometimes the net realizable value may be lower than cost. It may be due to if the goods may be damaged or the goods may be obsolescence or the selling price of the goods may be in declining trend due to market conditions or there may be increase in cost in completion or increased cost to incur the sales. The valuation methodology should be applied as follows. The valuation of inventory should be made by items basis, which falls in the same variety, which can be interchangeable. It should not be applied blindly for all the goods together. It should not be applied altogether for raw materials, work in progress and finished goods. If there are three kinds of raw materials means it should be applied individual item basis, not altogether for raw materials as holistic basis. Finally, disclosure requirements. The notes to the accounts should mention the accounting policies followed in the valuation, like FIFO method or weighted average method, which method is followed in the valuation. And the next one is inventory should be classified properly as raw material, finished goods, stock in trade, tools, spare parts, etc. And the value of the above item should be mentioned clearly. Next we will move into the final problem. Closing inventory at cost of a company amounted to rupees 9,56,700. The following items were included at cost in the total. A. 350 shirts which had cost of rupees 380 each and normally sold for rupees 750 each. Owing to the defect in manufacture, they were all sold after the balance sheet date at 50% of their normal price. The selling expenses amounted to 5% of the proceeds. B. 700 trousers which had cost rupees 520 each. These two were found to be defective. Selling expenses for the batch totaled rupees 3,800. They were sold for rupees 950 each. What should be the value of inventory as per AS2 after considering the above adjustments? In this problem, the inventory is valued at cost. We need to find out, based upon the given information, whether the inventory valuation at cost is proper or not. Cost per shirt is rupees 380 and the selling price per shirt is normally 750 rupees. Since there is a defect, it can be sold only for 50% of the selling price, which comes to 375. Additionally, selling costs need to be incurred at 5% of the revised selling price, which is nothing but 375 rupees. So that comes to 18 rupees 75 paise. So the net realizable value is 375 minus 18 rupees 75 paise, which comes to 356.25. So the cost is 380 and the net realizable value is 356.25. Among these two values, whichever is lower is 356.25. But the inventories are already valued at cost, but it is not correct as per AS2. So it need to be revised to net realizable value by reducing it to net realizable value from cost. So it needs to be reduced from 380 to 356.25, which comes to 23.75 rupees per shirt. So the total value which need to be reduced from the cost is 23 rupees 75 paise per shirt into 350 shirts, that comes to 8,312 rupees 50 paise. The next aspect of the problem is trousers. Cost per trouser is 520 and the selling price per trouser is 950, but it is also found to be defective. The selling expenses to be incurred to sell the trouser to be 3,800 rupees for whole batch. The batch is 700 trousers. So the selling expenses per trouser is 5 rupees 43 paise, which comes 3,800 divided by 700 trousers, 5 rupees 43 paise. Thus the net realizable value is 950 minus 5 rupees 43 paise, which comes to 944 rupees and 57 paise. When we compare this net realizable value with cost means the lower is cost. So the value considered for trousers is correct. So the inventory value rupees 9,56,700 should be reduced by 8,312 rupees 50 paise in respect of shirts only. There is a no change in the value of trousers since it is valued correctly. So the revised value of inventory is 9,48,387.50. Thank you. If you have any suggestions and doubts, please post those suggestions and doubts in the comment box. In my last video lecturing, I forgot to explain the concept of substance over form and materiality. So now we will look into those two missed concepts. First one is substance over form. Each and every transaction should be recognized based upon the events, not merely upon the legal form. And the next one is materiality. The financial statement should disclose all the material items which influence the users of the financial statements. Let me explain it through example. There is a theft happened at the company by its cashier for rupees 50,000. The turnover of the company is 500 crores per year. Though the amount of theft is bare minimum when compared with the turnover and the other expenses, it should be reported mandatorily because it will surely influence the decisions of the users of the financial statements. Because the theft implies that there are flaws or errors in the internal control system. Thank you. If you have any suggestions and doubts, please post those suggestions and doubts in the comment box. This is Anandh Kandasamy signing off.